Quantitative tightening is the biggest risk for investors in the next years. So far, what we have seen in 2022 is a very modest reduction in the balance sheet of the Federal Reserve and virtually no reduction whatsoever in the balance sheet of the Bank of Japan, the ECB, or the Bank of England. What we have seen is rate hikes. Rate hikes are obviously the headline-grabbing figure. However, we need to pay attention to two things. First, central banks are in losses. The accumulation of negative yielding bonds and extremely expensive bonds in their balance sheets are showing losses after the abrupt reduction in the price of bonds all over the world in 2022. Second, central banks need to reduce the balance sheet after the massive increase of 2020. Reducing the balance sheet by $5 trillion, which is not even starting to scratch the increase of 2020, would certainly have a very aggressive impact on valuations and prices of risky assets. But to that $5 trillion, we need to add that there is at least $2.5 trillion of deficit spending that will be refinanced. So that enormous reduction of liquidity in markets needs to come from the riskier assets out there, from high-yield bonds to peripheral bonds in Europe to the companies with the most challenging balance sheets and cash flow generation situations. The very difficult environment makes it very challenging for central banks to reduce the balance sheet as they should in order to combat inflation, because quantitative tightening does have also a very negative impact on the assets that they hold in the balance sheet. Therefore, it means more losses. And how do the losses of central banks become solved? Higher taxes, my friends. What you are going to see in order to bail out or to reduce the financial hole in central bank balance sheets is going to come from higher taxes to recapitalize those central banks. So when you thought it was a great idea to buy very expensive sovereign bonds and put them in the balance sheet of the central bank because nothing mattered, think about it twice, because there could be a very large fiscal problem and certainly a very large risky asset problem. Global commodities are coming down and have been correcting since June. If we look at the main factors, the first one, most important one, is rate hikes. Rate hikes do matter. And the fact that central banks have been increasing rates have certainly reduced the exuberance on the commodity market. The second one is the China slowdown. We cannot forget the Chinese slowdown, because the reality is that when China slows down, and it does so as aggressively as it has done in the past quarters, that means a lot less demand for copper, for oil, for natural gas, coal, etc. All those factors are temporary. The other ones that we need to pay attention to are underinvestment. The level of underinvestment in energy, particularly in fossil fuels, is so aggressive that the risk of having problems of supply in the near future is not small. Not only just in fossil fuels. If we look at the lack of investment in copper, lithium, cobalt, the reality is that the requirements of mining to deliver the level of growth in electric vehicles and renewables that are expected to happen in the next few years requires so much mining that it's very difficult to believe that that is going to be done without a much larger increase in capital expenditure, but certainly with an abrupt reaction in prices. So right now, what we are seeing is a very logical weakness in the commodity spectrum driven by the slowdown of China and the risk of stagnation. But the supply problems and the underinvestment problems need to be analyzed properly, because that is probably the biggest challenge in the next 5 years. The OECD Outlook is yet another blow to the bullish estimates of governments. The reality shows that economic growth globally is slowing down severely and that inflation is persistent. The narrative of inflation coming down and certainly of transitory inflation is gone. And the reality is that those that believed in the inexistent Keynesian multiplier should be very worried, because the reality is that if the Keynesian multiplier actually existed, and if we had seen the government spending work as a way of improving the economy, today most of the developed economies would not be seeing levels of growth that are close to stagnation, yet in fact close to stagflation. But what we would be seeing is very robust levels of growth. Considering the enormity of the increase in money supply and the increase in government spending of 2020, 2021, and the recovery of demand coming from the reopening of economies, the boost in growth should have been so phenomenal that many of the developed economies should have been growing at almost double-digit rates. However, the reality is that we're going closer and closer into stagflation, and that risk has not been reduced by just rate hikes. Central banks need to tighten further, interest rates need to go up, balance sheets need to come down, which is yet to happen, but more importantly, government spending needs to be reduced. The reality of the current risk should not lead to a global impoverishment of the population through inflation and stagnation. Thank you for watching this video. Please subscribe to my channel, like my videos, leave your comments below, and keep defending freedom. Thank you very much.